48 hours before the most consequential silver delivery deadline in modern exchange history, the CME Group executed a targeted shutdown of all metals trading on Globex. No preliminary warning, no scheduled maintenance window, no countdown timer. Silver was holding above $91 per ounce, sitting directly on top of a technical breakout level that analysts across multiple desks had identified as the launch pad to triple digits. The exchange issued a two-sentence explanation. Technical issues. Natural gas futures came back online within 50 minutes. Silver and gold stayed dark. No timeline. No additional statement. When metals finally resumed trading, silver was taken down in three distinct selling waves, from $91 down to $84.98. And simultaneously, the March open interest, the precise number of contracts formally queued to stand for physical delivery on First Notice Day, was obliterated. 11,156 contracts gone in a single session. More than half of the delivery pressure that had been building for weeks erased overnight. That was 2 days ago. Today is First Notice Day, February 27th, 2026. Silver is trading at $93.41, up $5.24 on the session, a 5.95% intraday recovery. The price they surgically suppressed at $91 2 days before this deadline is now trading $2.41, above where the halt hit. And the vaults that back every single one of those delivery contracts, they sit at the lowest registered inventory level ever recorded in the documented history of this exchange. Price recovering, vault emptying, delivery deadline arrived. That is what this video documents. Stay with me, because this is not a one-session story. It is the surface layer of a structural collapse that has been accelerating for 4 months, and what happens in the next 63 days will matter more than anything that happened in the previous 4 years. Everything you are about to hear is drawn from public exchange data, verified regulatory filings, and institutional research that anyone can cross-reference. If this channel is new to you, subscribe now, because the March delivery window opens today, and this channel will document every day of it. What is happening right now is not noise. It is signal, and the signal has been building since October. Let me establish the precise numbers we are working from. As of this morning, February 27th, 2026, first notice day for the March CME silver contract, 10,126 contracts are formally standing for physical delivery. Each contract represents 5,000 ounces of silver. That translates to 52.63 million ounces of physical metal declared by buyers who have submitted their delivery intentions. These are not traders rolling forward. These are not speculators accepting a cash premium to exit. These are participants who have formally notified the exchange, deliver the metal to my account. Against that demand stands CME-registered silver inventory, the only category of silver legally permitted to fulfill delivery obligations on this exchange, at 86.13 million ounces. 52.63 million ounces of declared demand against 86.13 million ounces of legally deliverable supply. That is 61.1% of the entire registered stockpile claimed on the first single day of the delivery window. In a market operating under normal conditions, delivery cycles are managed drawdowns. The weeks preceding First Notice Day see open interest roll forward as paper traders extend exposure and physical buyers hold firm. The historical delivery rate on CME silver contracts runs between 2% and 5% of open interest. Over the past several delivery cycles, December, January, February, that rate has been running near 98%. Nobody is rolling. Nobody is taking a premium to walk away. They are standing at the window and demanding ounces. 61% of registered inventory claimed on day one. Hold that figure. Before this video ends, you will understand exactly why it determines what the May and June delivery cycles look like. Here's the question the mainstream financial press has not asked about the February 25th trading halt. It was not the first one. On November 27th through 28th of 2025, the CME executed a 10-hour metals trading halt. The official explanation that time, a cooling system malfunction. That halt landed on First Notice Day for the December silver contract. At that moment, reports circulated of a Chinese industrial buyer that had notified the CME of intent to stand for delivery of approximately 30 million ounces. Following that November halt, silver did something no institutional forecast had modeled. It moved from $53 to $121.78 across the following 60 days, a 120% move in 2 months. Then, in late December and running into January, the CME applied margin requirement increases of approximately 50% over a 2-week window, triggering a cascade of forced liquidations that drove silver from $121 back to $63 in weeks. The pattern is now documented twice. Halt on or near First Notice Day. Delivery pressure crushed. Price smashed from a technical breakout. No regulatory consequence. No explanation beyond 2 words or a cooling system story. Silver recovers, delivery pressure rebuilds, cycle repeats. But here is what that competitor analysis is not including. This behavioral pattern has a documented legal precedent. Between 2016 and 2025, 8 major banks, including JP Morgan, Deutsche Bank, UBS, and others, paid a combined $1.27 billion in regulatory fines and civil settlements for systematically spoofing and manipulating silver markets. 2 JP Morgan traders were criminally convicted and served federal prison sentences. The Department of Justice documented the specific behavioral signature of these participants: layering, spoofing, and suppressing prices precisely at technically sensitive price levels and delivery windows. The current halt pattern, 2 shutdowns in 90 days, both at breakout levels, both adjacent to delivery deadlines, both with no adequate explanation and no CFTC investigation, fits that documented behavioral signature with precision. The difference is, we already know these participants have done this. We have court records and $1.27 billion in fines that prove it happened for years. Zero Hedge on February 25th cautioned that structurally bullish participants should remain vigilant about the substantial financial engineering embedded in this market. That is not a bearish statement. It is a warning from people who have read the court documents. CME registered silver is not an accounting entry. It is physical metal sitting in approved and independently audited storage facilities, assayed, warranted, and legally designated as the delivery backstop for every open futures contract on this exchange. It is the foundation on which exchange-based price discovery operates. Every registered ounce is the physical world's answer to every paper claim. In October of 2025, that foundation stood at 167.7 million ounces. That number had held above 100 million ounces through every major stress event in the exchange's history. Every squeeze attempt, every delivery surge, every manipulation allegation stretching back decades. The 100 million ounce threshold was treated by market participants as a structural floor, an implicit guarantee that the exchange's physical underpinning was impenetrable. On February 11, 2026, registered silver fell below 100 million ounces for the first time in recorded CME history. On a single trading session, 3,256,182 ounces were reclassified out of the registered category. The following session, a further 4.7 million ounces of eligible inventory disappeared. 2 sessions. Nearly 8 million ounces removed from the delivery-eligible universe. The drainage rate in early February was running at approximately 785,000 ounces per day. Seeking Alpha confirmed on February 26th that this drainage represents metal physically exiting the CME Vault ecosystem entirely, not a bookkeeping transfer from registered to eligible within the same storage facility. Buyers received their silver, they moved it out, it is not returned. Today, registered silver stands at 86.13 million ounces. That is a 49% collapse from the October baseline. In 4 months, half of all deliverable silver on the world's primary futures exchange has left the building and not come back. The delivery records that produced this drain are published. January and February 2026 combined have seen 74.38 million ounces delivered through CME contracts. That figure represents 86.4% of today's entire registered stockpile consumed across 60 days. The full calendar year of 2025 recorded 474 million ounces of CME silver deliveries, more than double the 203 million ounces delivered in all of 2024. The rate of physical removal is not slowing. It is compounding. Samsung reportedly secured an exclusive 2-year direct offtake agreement with a major silver mining operation earlier this month, bypassing exchange markets entirely. When the world's largest consumer electronics manufacturer makes a procurement decision to lock up mine supply through private contracts rather than exchange-based purchases, years in advance, that is not a speculative bet. That is a corporate risk management decision. It says, we no longer trust that the exchange will reliably deliver physical metal when we need it. There's a second corporate intelligence signal that is receiving almost no coverage. On February 23, 2026, the United States formalized a 15% flat tariff on all bullion imports. That tariff immediately adds $13.50 to $14 per ounce to the cost of importing silver into the United States from Mexico, Canada, or any other international source. For vault operators attempting to replenish CME registered inventory before the May 1st notice day, that cost differential materially undermines the economics of sourcing silver internationally and shipping it into exchange-approved warehouses. The arbitrage pipeline just got significantly more expensive to operate. The restocking math just got harder. If you find this breakdown useful, the like button tells the algorithm this analysis belongs in front of more silver holders before this delivery window closes. one tap. The CME narrative and the LBMA narrative are not parallel stories. They are the same physical market, operating through two different institutional frameworks, and London is historically where physical tightness surfaces first, before it registers on the CME screen. Silver lease rates in London have spiked to 34.9% annualized, with intraday peaks reported at 39%. Historical baseline for silver lease rates, 0.3% to 0.5%. What you are observing is a 70 to 80 times multiple over normal rates. When lease rates reach that level, the message from institutions holding physical silver in London vaults is unambiguous. They are refusing to lend. Either they anticipate prices are moving substantially higher in the near term, or they have counterparty risk concerns about the current market structure, or more likely both simultaneously. A lease rate of 39% is not a cautionary amber signal. It is a market distress flare fired in broad daylight. The exchange for physical spread, the premium that CME delivery buyers pay above London spot to receive metal in New York rather than London, has expanded from its long-term historical baseline of approximately 25 cents per ounce to over $110 per ounce. This spread is the primary arbitrage mechanism that keeps the two markets priced in alignment. When it reaches $110, that mechanism has broken down. Physical metal is being urgently demanded in New York, and the pipeline westward from London is either physically constrained or economically prohibitive at current rates. The LBMA publishes vault data with a 6 to 8 week lag, making real-time assessment structurally impossible. Analyst estimates for freely circulating London inventory, metal not earmarked for ETF backing, not allocated to specific accounts, and genuinely available for lending, currently run at approximately 4,000 tons or roughly 129 million ounces, slightly more than what CME registered vaults hold today, except that estimate is based on data that is now 4 months old, and London has been shipping metal westward continuously for months. Alistair MacLeod at goldmoney.com published an analysis on February 26th titled Blue Skies Ahead for Silver, noting directly that gold was steady, while silver remained volatile specifically because of how COMEX March contracts were maturing. When the most cited analyst in physical metals research is writing about silver supply stress the day before First Notice Day, that is not editorial timing. That is a live assessment of market mechanics. Here is the supply side story that major financial outlets are almost uniformly ignoring, despite its direct relevance to every vault figure cited in this video. Mexico is the world's single largest silver-producing nation. Its mines produce approximately 6,300 metric tons annually, roughly 23% of total global mine output. The primary producing states are Zacatecas, Jalisco, Sonora, and Sinaloa. These states are not coincidentally the operational territories of Mexico's most powerful criminal organizations. On February 22, 2026, U.S. and Mexican military forces jointly killed the leader of the CJNG cartel in Jalisco. The retaliatory escalation was immediate and widespread. Within 48 hours, coordinated cartel violence erupted across approximately 20 Mexican states. Highway convoys were blocked. Transportation infrastructure was disrupted. This was not background noise. In January, 10 employees of Vizsla Silver were abducted directly from their active project site in Sinaloa. 5 of those employees were subsequently confirmed dead. Vizsla's stock declined 50% in the days following. Multiple precious metals traders have since reported directly that CME-approved warehouses are not receiving replenishment shipments of Mexican silver, not because underground production has stopped, but because refined silver sitting at processing facilities cannot safely reach export terminals. The gap between what is being extracted from Mexican mines and what is arriving at exchange vaults is actively widening, not closing. China represents the second major supply constraint, and the SHFE data tells a story that parallels the CME drain with remarkable precision. Since January 1, 2026, the Chinese government has required special licensing for all silver exports. China controls an estimated 60 to 70% of global refined silver refining capacity. These export restrictions have reduced Chinese refined silver export volumes by approximately 40% since the policy took effect, according to analyst reports tracking the data. But look at what has simultaneously happened inside China's own vaulting system. On January 27, 2026, SHFE silver warehouse stocks stood at 544 tons. By February 9th, that figure had dropped to 319 tons, a 41% evaporation in less than 2 weeks. As of late February, CEIC data puts SHFE silver inventory at 306.596 tons, down from 346.369 tons the prior month. The front-month SHFE silver contract was trading at 21,124 CNY per kilogram against the January 2027 deferred contract at 17,598 CNY per kilogram, a 17% backwardation magnitude on a single exchange that dwarfs anything seen in modern SHFE silver trading history. China is not exporting silver. China is consuming its own exchange inventory at an accelerating rate. Both sides of the Pacific are draining simultaneously, and effective February 27, 2026, today, SHFE announced new hedging transaction limit rules for silver, raising margin requirements on silver hedging positions to 21%. Recognize what you are watching. Both the CME and the SHFE on both sides of the Pacific are tightening the administrative screws on silver delivery simultaneously. One exchange imposes a trading halt. The other raises hedging margins, both on or immediately before delivery deadlines, both as physical inventory evaporates. Then there is the geopolitical layer amplifying every physical signal in this market. This morning, Pakistan declared open war on Afghanistan. Pakistan's defense minister confirmed that Pakistani air forces struck multiple Afghan provinces after Taliban forces conducted coordinated large-scale attacks on Pakistani military positions overnight. The United Nations has issued a formal statement. Neither Pakistan nor Afghanistan is a meaningful silver producer, but an active, declared military conflict between nuclear-armed neighbors in Central Asia is precisely the risk event that redirects institutional capital into hard assets at scale. Gold is trading at $5,135.90 today, up $52 on the session. Silver at $93 against gold at $5,235 is, by almost any analytical framework applied to historical precedent, cheap relative to the geopolitical premium already priced into gold. Simultaneously, U.S.-Iran nuclear negotiations concluded in Geneva on February 26th without agreement. The United States currently has 2 carrier battle groups deployed in the Persian Gulf region. A breakdown into military escalation would affect Persian Gulf energy shipping in ways that have historically triggered outsized moves in precious metals. Mexico disrupted, China restricting and draining, London refusing to lend. An active declared war in Central Asia. 2 carrier groups in the Persian Gulf. The restocking pipeline that CME registered vaults need to replenish before April 29th, the pre-May first notice day deadline, has no identifiable large-scale source on any credible near-term horizon. Silver does not move in a vacuum, and the monetary environment surrounding this delivery cycle is among the most structurally supportive for precious metals in years. The dollar index sits at 97.78, down 9.2% over the prior 12 months. The 10-year Treasury yield has fallen to 4.0%, its lowest reading in approximately 3 months, as markets have priced in 2 Federal Reserve rate reductions before year-end. Real yields, the 10-year Treasury net of inflation expectations, have compressed from 1.98% to 1.72% in recent weeks. Each of these 3 movements is a confirmed tailwind for silver. The inverse relationship between real yields and silver prices is one of the most rigorously documented correlations in all of commodity finance. When real yields decline and the dollar simultaneously weakens, silver historically outperforms gold on a percentage basis, often dramatically. The gold-silver ratio has already compressed from above 100 in early 2024 to 57.78 today. Historical precedent during extended dollar weakness cycles suggests this ratio compresses further toward the 35 to 45 range. At current gold at $5,235.90, a ratio of 35 to 45 implies silver prices of $116 to $150 per ounce. That is not a fringe projection. It is a mathematical output of a ratio target that has been achieved in 2 prior dollar weakness supercycles. January's producer price index data confirmed conditions consistent with stagflationary pressure accumulation. The environment historically most explosive for precious metals precisely because it traps central banks between 2 incompatible mandates, controlling inflation and supporting economic growth simultaneously. The PCE deflator, the Federal Reserve's preferred inflation benchmark, is due next week. If that reading arrives elevated against a deteriorating economic backdrop, it compounds both the monetary and physical case for silver at exactly the moment the March delivery window is processing. JP Morgan's published 2026 average price forecast for silver is $81 per ounce. Silver is trading at $93.41 on the first day of the March delivery window. The bank whose traders were criminally convicted for silver manipulation is already $12 per ounce below current market reality, with a full 10 months of the year remaining. Citigroup projects $100 per ounce by March, with an upside scenario of $110 in the second half. BNC Technical Analysis identifies $91 to $92 as the structural breakout trigger that opens a pathway toward triple digits by mid-March. Silver is above that threshold right now, as this is recorded. The Kitco Silver Survey indicates 57% of retail investors expect silver to print above $100 at some point in 2026. Note the asymmetry. The institution with the deepest documented history of suppressing silver prices has a 2026 price target 13% below where silver is trading today. The institution most credibly at the center of the physical squeeze is simultaneously the one whose forward guidance is most disconnected from real-world physical market conditions. That is not an oversight, it is an institutional incentive structure. The futures curve on both the CME and the Shanghai Futures Exchange is in backwardation as of today. Near-term delivery contracts are trading at premium to longer-dated deferred contracts on both exchanges. But the SHFE magnitude is what demands attention. The front-month SHFE silver contract 21,124 CNY per kilogram. The January 2027 contract 17,598 CNY per kilogram. That is 17% backwardation on China's primary futures exchange. You do not produce 17% backwardation from speculative paper positioning. Sustained backwardation of that magnitude is generated exclusively when physical buyers, industrial users, manufacturers, sovereign accounts are willing to pay a 17% premium to receive metal immediately rather than wait for deferred delivery. It is a price signal from the real economy of China saying, we need metal now and we will pay 17% above future prices to get it now. That signal is not ambiguous. There is no alternate interpretation consistent with normal market behavior. Here is the data point that the majority of silver commentary is systematically misreading. The CFTC Commitments of Traders report, as of February 17th, places total CME silver open interest at 131,496 contracts. The managed money net long position, the aggregate bullish exposure held by the speculative trading community, stands at 12,121 contracts. 1 year ago, in February 2025, that same managed money net long was 54,415 contracts. That is a 77.7% collapse in speculative bullish positioning year over year. Silver moved from $30 to $121.78 during the precise period when the speculative community was reducing its long exposure by more than 3/4. This rally was not manufactured by hedge fund pile-ins. It was constructed by industrial buyers, sovereign wealth accounts, and institutional entities physically removing metal from the exchange system and not returning it. The distinction is structurally decisive. Every prior silver price surge in modern market history, 1979, 2011, 2021, was driven by massive speculative long accumulation in futures. When those positions peak, the trade becomes crowded. Reversal pressure accumulates. The shorts find their volume. The buyers standing for physical delivery today are not crowded speculative longs carrying trailing stops. They are entities that absorbed a 48% drawdown from $121 to $63 and held. They are by construction the most conviction-weighted participants in this market. They have already proven their tolerance for the volatility the exchange can manufacture. The ETF flow data confirms the directional commitment on the institutional side. SLV recorded net inflows of $849.6 million across 5 trading days through today. 3-month inflows into SLV stand at $1.58 billion, 1-year inflows $3.61 billion. These are not retail momentum flows. These are sustained institutional allocation signals at institutional scale, persisting through the February crash and recovery. SLV short interest reached a record 73.55 million shares, 12.8% of outstanding, in early February. That short interest has since collapsed to 45.79 million shares, a 43% reduction in 3 weeks. The participants who carried maximum short exposure through the crash were covering their positions during the precise period when retail conviction was at its lowest ebb. They were not right to be short. They were cutting losses. On February 25th, the day of the CME halt, SLV options volume hit 61 million shares in notional exposure in a single session. Implied volatility on SLV ran at 99 to 100.3% annualized against 37% historical realized volatility. That is a 280% premium of implied over realized. Options market makers do not price silver at 100% implied volatility because they expect normal commodity price behavior. They price it that way when the structural setup suggests a discontinuous, nonlinear price event in the next 60 to 90 days. That is the options market communicating what the vault data already says in plain numbers.